The broadcast is now starting. All attendees are in listen-only mode.
Welcome to TaxLink's latest webinar. Today we have, this is basically part of a series of webinars we're doing on US tax issues. We had a first one maybe several months ago with John Richardson, and he was accompanied by Karen Alpert from University in Australia, which touched upon the transition tax. Today we're doing a follow-up. We're going to touch upon the exit tax. And hopefully sometime in early 2019, we'll do something on guilty to kind of wrap up this series of US-themed tax webinars. So before getting started with our 12 questions, let me get some admin issues out of the way. This webinar is being recorded. We'll have an audio recording available for you probably early next week. We will also have a transcript that will take us a bit longer to get out to you, but we'll share it on social media, send you an email about it, etc. If you have any questions for John as you listen in to what he has to say, use the GoToWebinar control panel to submit those questions. I will try to incorporate them as they come in into the discussion. Also, if you want to receive CPD credits for this webinar, make sure you're paying attention. Our system can track everything. So if you're not paying attention and it shows that you had logged on but you weren't actually being attentive, then we will not offer you those CPD credits. So just make sure you're participating at least passively in the discussion we're having today. So without further ado, I would like to hand on the floor to John to introduce himself, and we'll get started with our questions. John?
Great. Thanks, Matteo. So yeah, as Matteo points out, this is not the first time doing a webinar with TaxLink. My name is John Richardson. I am based in Toronto, Canada. I am a lawyer, and I run a very, very narrow specialty law practice, which is designed to help U.S. citizens and green card holders who live outside the United States deal with the avalanche, and I emphasize avalanche of problems that befall them because of their status as tax residents of the United States. I was really quite interested to hear Matteo's introduction because, as he points out, in April, Karen and Albert and I did a webinar on the transition tax. Today we're doing the exit tax, and I'm looking forward to doing the guilty provisions later. But I think what's important to understand is that these three taxes have one very important thing in common. And what they have in common is that in each of these cases, whether it's transition tax, whether it's exit tax, or whether it's guilty, all three of these things are what I would call fictitious tax events created by the U.S. Internal Revenue Code to generate taxable income for the United States that is overwhelmingly, at least and exclusively in the cases of guilty and the transition tax, and overwhelmingly in the case of the exit tax, a way to essentially confiscate foreign assets in other countries. And make no mistake about it, the 877A exit tax in the Internal Revenue Code, which has been the law since 2008, regardless of intent, operates primarily in relation to Americans abroad who renounce U.S. citizenship, or green card holders who hand in their green cards. And in the case of Americans abroad especially, what this means is the exit tax is applied to non-U.S. assets, non-U.S. assets, but more significantly that have been accumulated at a time when these people did not even live in the United States. And that is why the 877A exit tax is so completely different from the exit taxes levied by other countries, what they call them departure taxes in other countries, that are levied when people break tax residence. But the point is that with Canada and Australia, what happens is that these departure taxes are imposed at the time that they leave Canada or Australia. But as a practical matter, for Americans abroad, they have left the United States, in many cases a lifetime outside of the United States. So these, for all practical purposes, are taxes that, and this is incredible, are imposed on non-U.S. assets that were accumulated when the individual was not even an actual resident of the United States.
Right.
So, I mean, this is this goes so far beyond any exit or departure tax that's ever been levied in the history of the world. It's astounding. No doubt the United States would be proud of this. Questions, Matteo?
Thank you for that introduction. We know where you stand, John, very clearly following that introduction. So
I think that was important. I think that was important.
Yeah. To establish your ground and your point of view. That's good to get it out of the way from the beginning. We have 12 questions here, John. Some of them are more complicated than others. Some of them are more, I guess, specific than others. Let's get started with some of the more general questions. So, which people renouncing the U.S. citizenship are subject to the exit tax? Just to kind of get us started with that.
Right. So, not everybody. Not everybody. The people who are subject to the exit tax are people who are defined in the Internal Revenue Code as covered expatriates. Now, a covered expatriate is a person who triggers one of these three events, trips one of these three wires. The first would be that the person has had an average U.S. tax liability of what, as of today's date, is I believe $165,000 per year over the last 5 years. So an average tax liability, U.S. tax liability, that's not income tax. And most people, in my experience, are not caught by that because most people live in countries that also impose tax, like Canada or Australia, for example. And the taxes they pay in Canada or Australia are used as tax credits against U.S. taxes owing, meaning they tend to not owe that kind of tax. However, people in Saudi Arabia, Dubai, that have no income tax imposed by those countries may be in danger. Interestingly, though, it tells you a lot about the philosophical underpinnings of the exit tax, because by making somebody a covered expatriate because of a high U.S. tax liability, it really means that the United States view is that people renounce U.S. citizenship for tax reasons, and that really they don't care if you renounce. What they care about is the tax revenue they lose. So that's the first test. The second test is an asset test. Now, oh, and by the way, the first test, 165,000 is indexed to inflation, I believe, for 2019 to 168,000. One would expect, though, somebody with that kind of tax liability would have a lot in the way of assets. And what's interesting is
let me jump in, John, 1 second, because I have a question here just for clarification. Basically, when you say the 165,000 in U.S. tax, is that paid per year, or is it not 165,000 in assessable income? That's the question we're getting from one of our listeners.
Right. Okay. Good question. It has nothing to do with income. It has to do with actual tax paid to the United States. Actual tax paid to the United States under a somewhat nuanced test. Okay. And it's an average over the 5 years, and that's often very much confused. Okay. So it's a tax liability test, not an income test.
Okay, go ahead with the second test now. Right. Sorry, I interrupted you there.
So the second test is based on assets. Now, one would think that if you were paying that kind of U.S. tax, that you would have a lot in the way of assets. So one would expect a very high asset level to trigger the exit tax. Wrong, wrong, wrong. It's a figure of $2 million U.S. dollars. Assets less liabilities, $2 million U.S. dollars. Now, that's not indexed to inflation either. Now, that might not sound like a humongous figure, to somebody who lives in Middle America in a small town. But for anybody who owns a house in, any major city of the world, including U.S. cities, New York, Boston, in Canada, Toronto, Vancouver, London, etc. That's, a house can easily cost over $1 million. That's just what a house costs. And for people like that, they can often be covered expatriates just because of they happen to live in a certain area, and they bought a house 50 years ago, and that's what the house is worth. Add to that a salaried employee with a pension plan in, say, Canada. My typical example is a University of Toronto professor who owns a house near the University of Toronto in downtown Toronto and has a University of Toronto pension. I guarantee you they have over $2 million in assets and they're a covered expatriate. But I also guarantee you that their incomes may not be that high, and they probably many of them probably have trouble paying their bills. on a cash flow basis. So it's quite an amazing thing. So that's the asset test, and I might pause here and ask if there are any questions about the asset thing. I think it's fairly clear, but
let me see. Yes, there is a question about the assets. Does assets include equities of private companies?
Oh, absolutely, positively, absolutely. Assets means everything under the sun. There are some tax preparers, when they complete the Form 8854, that even detail, I think trivial personal possessions. I would not go that far. But it does include, in its plain terms, things like the value of personal use automobiles, stuff like that. So it goes way beyond investment assets. Now, practically speaking, okay, although it does go beyond that, I mean, you're concerned with financial assets that have, appeared as part of your tax filing for year after year. But the answer is absolutely yes. Let me put it another way. If there's a word to describe it in the English language, it's included as part of the asset test. Actually, no, there are a couple exceptions. Social Security, okay, in other countries would not be included as an asset. Thank God. Third, you have to also certify that you were compliant with the obligations imposed by Title 26, which is the Internal Revenue Code of U.S. laws for the 5 years leading up to the expatriation, and that includes paying all taxes, completing all forms, et cetera, et cetera. And this is a very big problem for people because, nobody understands U.S. taxes very well. And almost all people have, issues. Their tax returns could be improved, et cetera. So, this becomes a concern. I mean, have they filed, all of the right types of information returns, et cetera? So that's the third test. If you can't certify 5 years, then you're also going to be a covered expatriate. And what that means is the people who would just renounce U.S. citizenship without having filing taxes are, by definition, covered expatriates. So that's the test. Trip any one of those three. There are a couple exceptions. Do you want to hear the exceptions or not?
Sure, go ahead. Let's cover the exceptions too, and let me combine it. Let me actually combine it with the next question, just so we could
sure.
Move ahead too. It's like, how can you avoid becoming covered expatriate?
Okay. Well, there's 3 ways to avoid becoming a covered expatriate, because there's 3 ways you can be a covered expatriate. Okay. But let me answer directly first, and I'll give you, a couple of exceptions. Okay, the first would be to obviously make certain that you're not paying that kind of U.S. tax. Now, one point I would make here is that a lot of people file jointly, and it's the amount that appears on the joint return that would be used to calculate the U.S. tax liability. So, for a practical purpose, for some people, they want to separate, no longer file jointly. If they file as individuals, they can, reduce their tax liability, right? Other ways would be, well, so how else do you reduce your tax liability? Well, maybe you stop working. Why not? You make less money. We did a seminar on the transition tax last, I guess it was April.
Right.
For somebody with a couple $1 million of retained earnings, they're gonna have a transition tax that's so high that their average tax liability could be, over 165. So anyway, you're gonna reduce the tax somehow. Secondly, gifting. You want to get below that 2 million. Now, the general sort of textbook, if you were to read about this, say, well, we make gifts to get below our 2 million. As you know, the Tax Cuts and Jobs Act, the gifting limitation is now up to 11 million. And that gives a lot of room for a lot of people to get below 2 million. Who do you make gifts to? Well, one obvious would be the non-U.S. citizen spouse, right? You can make a gift. You have to file the gift tax return for that, but that's a possibility. And that's part of, what expatriation planning is. A third way to avoid covered expatriate status would be if you're not tax compliant or if your taxes are in bad shape, get them cleaned up. Do some back filing, that sort of thing. Now, there are 2 kinds of people, regardless of net worth, would not be subject to the exit tax, provided that they are tax compliant.
Mm-hmm.
First group, and I see a lot of this, living in Canada, would be those who were dual citizens at birth. So people who were, for example, a dual Canada-U.S. citizen from birth, who's living in Canada, is a tax resident of Canada when they renounce, and has not lived in the U.S. for 10 of the last 15 years, would be able to escape the exit tax. They would not be a covered expatriate. And this is unbelievably arbitrary because let's compare two situations. Let's compare a person who was born in the United States to Canadian parents and was therefore a dual Canada-U.S. citizen from birth. Let's say the person compiles hundreds of millions of dollars of assets, hundreds of millions of dollars, decides that because of the U.S. estate tax, he wants to get out of the United States. Well, all that person really has to do is get Canadian citizenship, move right back to Canada, live there for 10 years as a tax resident, make sure he's compliant with U.S. taxes, and he will avoid the exit tax. Compare that to a person born in the United States to American parents, who then say moves to Canada as a kid. Let's say that person compiles hundreds of millions of dollars of assets. That person is stuck, will have to pay the exit tax, is not entitled to the dual citizenship exemption because he didn't have Canadian citizenship at birth. So Barack Obama once said that in America, the circumstances do not determine the outcome of your life. The truth is that when it comes to the exit tax, not only do the circumstances of your birth, but the circumstances of your parents' birth can likely determine whether you have to pay the exit tax. It's incredibly arbitrary. So that's one. And the second would be the people who can renounce before the age of 18 and a half. And again, they should be tax compliant as well.
Okay. Before we move on, John, I guess you have people enthralled here because they're just dropping questions left and right. So let me do. I'm going to backtrack a bit here and ask some of these questions that are coming in.
Sure.
This is going back to, I think, the third test that you answered in the first question. Is it total assets, cash, equities, etc., combined at any time over the past 5 years?
The $2 million test? No. It's right at the point of renunciation, okay, on the day of renunciation. So if you have clients, or whoever is listening, if you have clients or if you're an individual who's concerned with the $2 million test, the key point is the date of actual renunciation. So that means that any adjustments need to be done before you renounce. And I would also, well, I can tell you what I encourage people to do. Actually, I insist as gently as I can, is on the day they renounce, they have got to itemize all of the values of all of these things, along with the exchange rate, right? Because don't forget that all of these things need to be converted to U.S. dollars, right?
And this is either U.S.-based or foreign-based, right? That's a second question to this, or a second addendum to it.
The worldview of the United States and the Internal Revenue Code is that every individual and every asset in the world is subject to U.S. taxation unless there's an exception to it, okay? And to be very, very, very clear, it is all assets in the world that are sucked into the vortex of this. I guess Social Security would be the exception. And this is the problem because it primarily affects assets that were accumulated by American citizens after they moved from the United States.
Mm-hmm. Okay. Next question that we received here, regarding the average U.S. tax liability per year, for how many years are they considering this average?
5 years. 5 years prior to expatriation. So if you renounce next week into, this is what, 2018, it would be the average liability for 13, 14, 15, 16, 17.
Okay. And last but not least, and then we'll move on to the questions that we have here. Could you do a gift to a foreign foundation in order, I guess, to decrease your tax liability and whatnot?
I don't see any reason why not. I mean, I've never thought about that specifically, and I have no experience with that. So I will give you what I think is the answer, but of course I can't guarantee it's the answer. I see no reason why you could not do that. I remember, though, that gifts have their, the whole transfer tax regime is another section of the Internal Revenue Code. You've got to file the appropriate returns, and filing the appropriate returns would be part of meeting the 5-year certification test. I would also like to add one other possible technical point here. And I consider this to be an unsettled question, but there are people with strong views on this one way or the other. If you're going to make gifts to reduce net worth, which is perfectly legal, prior to renunciation, I encourage you to separate the year of the gifts from the year of the renunciation. Okay, do not do it in the same year. I'm not saying for sure you can't, but I have seen, arguments both ways. So, my view, avoid potential problems. Make the gift in a year that's different from the year you expatriate.
Excellent. Okay, thanks for that, John. Let's move on to our questions here. Is the exit tax really a collection of 4 separate taxes? How do these separate taxes work?
Right. Well, it's at least 3, and I would say that there's a 4th component to it. Yes. So you'll find all this in section 877A of the Internal Revenue Code, where I've written probably at least 30 blog post articles on this. If you want to email me, I'll send you some links. But first tax, okay, is what I would call the deemed dissolution of property tax. It's treated like a capital gain. So if you had a piece of real estate and you sold it, you would pay a capital gains tax on that. So for property, things like real estate shares, etc., okay, when you expatriate, and if you're a covered expatriate, they would pretend that you had sold all your capital property and impose a pretend tax on the pretend sale. So, very simple example, you own a small 3-unit apartment building, you bought it for $100,000, you sell it for $1 million. The fair market value is $1,100,000. If you renounce, they would simply attribute a $1 million capital gain to you the year that you renounce. So that's how the property sale thing works. Now the next 2 are very interesting, very punitive, very, very dangerous. They are taxed differently. These are examples of full income inclusion. And the first are what are called specified tax deferred accounts. These are things like IRAs, this sort of stuff, right? And the theory there is that at least for certain types of these things, you get a tax deduction when you contribute to them. So the idea is that it's essentially a payback, if you will, of deductions that you had earlier plus the accrued gains. But anyway, the problem there with that type of thing is that it's a full income inclusion, right? Very dangerous. Imagine $1 million specified tax deferred account, full income inclusion put on your tax return in the year that you renounce. That would not be good. Bear in mind, you've got no income realization event to pay for this. So that's the second thing, the specified tax deferred account. The third, they define as deferred compensation plans. Mm-hmm. That's tax speak for pensions, really. Mm-hmm. Where this is now, the pensions, so you have full income inclusion of the pensions. Now that wouldn't mean the full amount would be taxed because, perhaps you made some contributions to it, et cetera. I mean, you'd have to run the tax calculation separately. But it's full income inclusion on deferred compensation plans. Now, get this, okay? You think this is unfair. You just, now let's talk about the difference between a domestic deferred compensation plan, meaning U.S., and a foreign one. Well, let's take a professor with a pension from, say, the University of California, compare that to, say, a pension from the University of Toronto. The covered expatriate with a pension from the University of California, which is a U.S. pension, will actually be able to, it's considered on the expatriation, but they are able to file an election so that the tax is paid as the pension is paid out. In other words, the capital value of the pension is not attacked. But if it's a non-U.S. pension, they will include the full $1 million, and you have to pay tax on the full $1 million, if you can imagine it. So my view is that this should be viewed as the confiscation of foreign pension plans, okay? All right, so that's the third. And the fourth is, I don't know if I'd call it separate kind of tax, separate kind of exit tax, but there is a provision that requires you to consider, if you're a beneficiary of a trust, all right, how the future distributions from the trust would be taxed. So those are the four aspects to how the tax is calculated.
Excellent. I guess you covered basically the fourth question, which was why is the exit tax particularly confiscatory when applied to non-U.S. pensions? You mentioned that just now. So do you have any additional thoughts on that, or I think your point was pretty clear?
Okay, well, maybe to clarify, it is particularly punitive. It's over the top. I mean, they're taking their pensions.
Right. Okay. I think now it's clear.
Now it's clear. Thank you for that.
Thanks, John. Okay, next one. Now, more in terms of, I guess procedural stuff. What are the exact requirements that must be met in order for those renouncing U.S. citizenship to effectively log out of the U.S. tax system?
Okay. So, everything about American life is in the Internal Revenue Code. It is the Bible of America. And
John, sorry, before. I'm going to backtrack again. We got a question on the previous question.
Okay.
Someone's asking, it wasn't clear to me if IRA accounts would be included in this exit tax or not.
Absolutely, positively, yes.
Under 2 million.
I'm sorry. Would you repeat the question in its entirety?
Basically, it wasn't clear to me if IRA accounts would be included in this exit tax or not, if even total assets under $2 million.
Okay. Pause. Now I'm going to try to improve the answer here. Okay. Now, if we can backtrack, I think the first question this morning was what people are subject to the exit tax. Right. And my answer was that only covered expatriates are subject to the exit tax. The inclusion of IRA income is part of the exit tax. So therefore, only covered expatriates would be affected by this. So if you're not a covered expatriate for any reason, then you would not be affected by the IRA inclusion. Okay? Right. Now, if the question was if your assets are below 2 million, well, if your assets are below 2 million and you are not a covered expatriate for any other reason, okay, then the IRA would not be included as income. But the test is if covered expatriate, then these horrendous consequences kick in, of which the IRA inclusion is one of those horrendous consequences.
Excellent. I think our listener is happy with that answer because he said perfect.
Oh, I like it.
Let's go back now to the question we were discussing about the exact requirements that must be met in order for those renouncing U.S. citizenship to effectively log out of the U.S. tax system. Okay,
so let me give you an example. Mm-hmm. Let's say that some of you are professionals who are advising clients on expatriation. And let's further hypothesize that you have a client who is getting ready to renounce U.S. citizenship tomorrow. But you said you were going to attend this seminar today to make sure they were safe and provide instructions for what they're going to do. So let's imagine that you have a client who's going to renounce U.S. citizenship tomorrow, December 7th. So they walk into the consulate and renounce U.S. citizenship and leave a free person. But they have to do some cleanup here. Here's the tax cleanup you have to do. 1, you were a U.S. citizen up until December 7th, 2018. Therefore, you would be taxed on your worldwide income and subject to all the other requirements up until December 7th, 2018. So clearly, you'd have to file a final U.S. tax return for 2018. But as of December 31st, 2018, you're no longer a citizen, so you're a non-resident alien. Mm-hmm. So what you're doing is you're filing a non-resident alien return, or at least in most cases, you file a 1040 NR non-resident alien return, but you include as a schedule 1040, normal return up until December 7th. Okay, right. So you're filing non-resident return with a schedule that's a 1040. But in addition to that, you have to complete this form 8854. So you Google form 8854. And good news, the 2018 version is all ready, so your client can even complete it tomorrow. You can help them with it. Now, remember I said that to avoid covered expatriate status, you have to certify 5 years of compliance. Right. Form 8854 is clearly where you can certify the 5 years of compliance. I'm not sure that it's the exclusive way to do it, but the Form 8854, among other things, is where you certify the 5 years of compliance. It's also where you list all your assets and answer questions that would confirm that you either are a covered expatriate or not a covered expatriate. Now, Form 8854, which is a separate, I'll call it an expatriation return, one, needs to be attached to your final tax return, and two, must be sent separately to another address somewhere in Philadelphia, just to document the filing of that. And then finally, the Internal Revenue Code requires the State Department to turn over to Treasury the names of people who have renounced, relinquished U.S. citizenship. By the way, this also applies to green card abandonments, although we haven't used that language. And then, of course, if they're really, really lucky, their name will be published as having renounced U.S. citizenship. Some people regard it as a badge of honor. Some people are mortified. But anyway, there's your process.
Okay, excellent. I think that's pretty clear, the step-by-step process. Okay, our next question is, how does the U.S. punish future beneficiaries if they receive gifts or bequests from people renouncing their U.S. citizenship? Getting back into the gift.
Right, renouncing U.S. citizenship. Yeah. Okay. So if people renounce U.S. citizenship and are covered expatriates, what they've done is they've established a new gift tax regime for covered expatriates who have the temerity to actually allow their capital to come back into the United States. Who would want to have it taxed again? But anyway, to have it come back into the United States. So what they do is this. And this has not been imposed yet. I'm not sure exactly why, but it's totally outrageous. So let's imagine that, Matteo, let's imagine that you find out you're a U.S. citizen. You hate it, or maybe you are. You hate it.
I'm not.
No, you're not. Okay. Well, let's pretend you are. Okay.
My parents are.
Oh my God. Well, you better take this to them. Let's imagine that you're a U.S. citizen. You renounce U.S. citizenship. You have $5 million of cash. Now, you wouldn't pay an exit tax because there's no gain on cash. But if you then say, you know what, I have a relative or a wife or somebody who's U.S. and I want to give them that $5 million. Well, then the Internal Revenue would say, not so fast, buddy. You're a covered expatriate. You're a bad person. You have dirty assets. And if dirty assets go back to a U.S. person, we're going to confiscate them as a gift, 40%. It's the only time the United States imposes a gift tax on the recipient of a gift rather than on the person who makes the gift, because you're no longer a U.S. citizen. They cannot tax you. So that's the problem there. And that's beginning to work its way through regs and stuff like that. I mean, would not believe what the regs say. So what this does mean, by the way, from a practical point of view, and this is something that I always get people to do, is they need to compile what I would call a renunciation file. It shows all their assets and exactly how they got to the valuations and all this sort of stuff. And then what you should do is make copies of it, give it to your family members for generations. If you're not a covered expatriate, as evidence that, you were a good person who renounced and not a tax evader.
Okay, excellent. You covered some of the exceptions to the exit tax regime, so I'm going to skip that question. I will jump into, these are a bit more specific. They're questions that we've received just a few hours ago, and I think, some of them pose some interesting questions. So how would foreign and domestic property owned by U.S. citizens be dealt with? Does this change if the property is held by a corporation for which the U.S. citizen is a majority shareholder? How are properties handled where the U.S. citizen relinquishing citizenship is only a significant but not majority owner of the property? Any thoughts there? I know it's a long and loaded question.
Not really, no. You just analyze it in exactly the same simple-minded way. Remember that all property anywhere in the world owned by the person would be included. If they're a majority, I don't know, let's say they have 60, the property owned by the share. Okay, if you own the shares in the corporation owns the property. You don't own the shares, the property, the corporation does. So your assets that are subject to the exercise would be the shares in the company. That's number one, okay, you know, whether foreign or domestic. And number two, you just would calculate what share of the property the company owns. So if the company owns 2/3 of a piece of real estate, then the question is, how would that 2/3 ownership of the real estate impact the value of the shares of the company? And it's the shares of the company that are, you know, subject to inclusion for net worth determination and for possible exit tax purposes. I think that pretty much answers it.
Okay, perfect. Thank you. The person who posed that question is listening too, so if he needs some follow-up, I'll jump in and provide you with a follow-up question.
Sure.
Let's go on to the next one. If personal loans are taken against retained earnings of a corporation and the person then relinquishes U.S. citizenship, how would these loans be treated? Would they be treated as taxable? And if at some point in the future the loans were forgiven, essentially making them income, would they then be taxable by the U.S. even if the person were no longer a U.S. citizen?
Yeah, you know, I saw that question this morning. I'm not entirely sure. I'd have to think that through, but I'll think it through sort of out loud and do the best I can with it.
Okay.
All right. So I think we need to begin with the principle that there may be a difference between a loan from a domestic corporation or from a foreign corporation, particularly if the foreign corporation is a controlled foreign corporation. My understanding of the subpart F rules is that the loan would be included in income at the time that it was made if it's a controlled foreign corporation. Mm-hmm. But basically, from the perspective of the individual renouncing, okay, if you borrow money from anywhere, it would become a liability, right? It becomes a liability. So when you complete your Form 8854 balance sheet, presumably it would just be a liability. So let's imagine you have a company with $2 million of cash, and let's say you borrow $1 million. Okay, the shareholder, you know, at least from the point of view of the corporation, has to pay it back. Okay, so I guess that would be a liability. But on the other hand, okay, from the point of view of the corporation, I think the loan would be an asset, wouldn't it? Which means that you haven't really reduced your net worth because you're still owning the shares, and the loan, the $1 million loan, is an asset from the perspective of the corporation, so it increases the value of the share to you. It's a liability from your point of view, so it decreases your asset level. Now, on the issue of paying things back, you know, so you've renounced. I mean, the U.S. has no jurisdiction over you if you're no longer a U.S. citizen, unless, okay, the forgiveness of the loan was considered somehow to be U.S. source income, therefore would have to be dealt with from that perspective. And that's sort of the best I can do, thinking out loud. I don't know.
There was a clarification here by the person who posed the question. Is basically it's in case you are the majority shareholder of a company which makes the loan.
Well, if you're the majority shareholder of the company who makes the loan and it's a foreign corporation, it's clearly a controlled foreign corporation. I think there's income inclusion. There's income inclusion right at the point the loan is made. So, you know, if you've already paid the tax on the income and they forgive it, you know, down the road, I mean, would you really be double taxed? I don't think so.
Okay, thanks, John. Now, a different type of question now, more in terms of what options are available to U.S. citizens once they renounce their U.S. citizenship in terms of returning to the country. So the question is, what type of citizenship options are available to U.S. citizens wanting to relinquish their citizenship but still have relatively easy access to the U.S. for personal and business visits for 60 to 90 days per year? Would the Grenada plus the E1 or E2 option be the best? What other options are there? What are your suggestions there?
Yeah, can I break that into two questions? Would you mind?
Yeah, go for it.
I think if we could address that from the point of view of, one, once you are no longer a U.S. citizen, how does that affect your ability to come into the United States, period? And then perhaps we could talk about second citizenships and how that they might impact the other issue.
That works.
Yeah, okay. This is incredibly interesting. So let's start off with, you renounce U.S. By the way, I hope to God nobody would renounce, as oppressive as it can be, I hope to God nobody would renounce U.S. citizenship unless they have another citizenship. I mean, there are a few people who do, but I think that's a terrible idea. But in any case, So you renounce U.S. citizenship, and from the U.S. perspective, you're just treated as a citizen of whatever country you're now a citizen of. Now, what does that mean in terms of entry into the United States? Well, I live in Canada, so it's fairly easy. Canadians, I have discovered, have incredibly generous access to the United States. So I mean, as long as they're careful to, I think they can stay up to 6 months. I think I should know that. Mm-hmm. But I think it's 6 months. I'm sorry, I know more about it. But anyway, so they have easy access, and a lot of them. And this is, I think, a policy decision on the part of the United States. A lot of Canadians seem to like to winter in places like Florida and Arizona. They want their money, obviously, right? The only capital they don't want coming in is dirty money from Americans who are renounced, right? That's dirty money. So, from the point of view of, say, a UK citizen, then we move to what I would call visa waiver countries. They can come into the United States no problem. Right. They don't need a visa. There's an ESTA thing they file, et cetera. And then there are citizens of countries where I think it's more dangerous. An Iranian American dual citizen. If you're kind of come in from Iran, you probably need a visa and all this sort of stuff. So that's the first issue. The second issue is this: that if you look at the Immigration Nationality Act, Section 212, you will find an astoundingly large number of reasons why people are inadmissible in the United States, regardless of citizenship status or anything else. Mm-hmm. And I would encourage anybody with any kind of past transgressions with the law to have a look at that, okay? Because, for example, I was once working with somebody and all getting ready to renounce, and all of a sudden he tells me that he was arrested many years ago. Blah, blah, blah. And, it's not entirely clear whether this particular thing would have made him inadmissible or not. But there are reasons why people are not admissible in the United States. So, I hate to put it this way, and this is not intended to be humorous, but if you're a hardened criminal, do not renounce U.S. citizenship, okay? Well, no, obviously, because if you're a citizen, you have a right to enter the United States, right? Right. It's the stuff can be really perverse. But all right, so now that's the first thing. So you really need to sit down and say, what does my life look like as a non-U.S. citizen? What kind of visa, if this is important to you? All right, maybe it's not. What sort of visa might I need? Are there any reasons why I would be excludable? And on the excludable thing, as you may or may not know, cannabis, marijuana, whichever it's called, since October has been legal in Canada. It's been so promoted in Canada, it almost makes me feel like I should be out smoking the stuff, support the government. It's just so important. But, what's interesting is that it's in violation of federal U.S. laws, right? Right. So the question, this is a big topic for Canadians right now, is, what if I either work in the marijuana industry or smoke it? Would that make me excludable from the United States, right? And the answer is technically it might. Anyway, so that's the first category problem. Secondly, citizenships. Now, as you may know, there is a huge market and a growing market for buying second citizenships. Mm-hmm. And you can also get it through, marriage and a variety of other things. Obviously, there are some citizenships that are far better than others. You mentioned the Grenada thing. I think that's really a fascinating option because citizenship in Grenada is, and I think I'd be comfortable recommending this, citizenship in Grenada is relatively easy to get. It's not quite a purchase of citizenship. The money goes a long way and not much of it to get citizenship.
It's not like getting your Cypriot passport.
Sorry?
Not like getting your Cyprus passport, which No,
Cyprus.
The investment is 2.5 million euros, I think. So go ahead, John.
Well, but they're very different types of things because the one I think is giving you EU access, etc. But the thing that's interesting about Grenada is that they have the kind of treaty with the United States that would allow for a citizen of Grenada to get an E. It's either an E1 or an E2. It's an E something visa to do business in the United States. And this is a fantastic thing. And the reason it's fantastic is that you can get the visa through Grenadian citizenship to do business in the United States, but you can avoid the green card, right? The green card is what makes you a U.S. tax resident. Right. It can destroy your life because of worldwide income. Mm-hmm. So there's this huge market. All these people are out promoting this EB-5 program in the United States. My personal view is you should avoid that. Use the Grenadian citizenship, E2 option, because you can get the access to the United. I mean, if you're really just trying to be able to do business there, you can get the access to do business without becoming a tax resident, right? So you get the best of both worlds.
Are there any other options out there that you know of, or any other suggestions
for citizenship?
Yeah, that you think would work, or?
Well, I was at a conference in Ottawa, Canada last week, and Canada acknowledges they need lots of immigrants and citizens, largely to take over businesses. I was talking with somebody from the province of New Brunswick, and I said, I don't know why you don't market this in the United States. Imagine 5 years Canadian citizenship, blah blah blah. Then maybe they can get that type of thing and then come back into the United States as Canadian, for various reasons. I think the answer is it depends on why you would want access to the United States. If it's as simple as I just want to be able to travel there, I wouldn't worry about it that much. If it's I want to run businesses there, I think that's an entirely different matter. And I think you've got to be careful about becoming a tax resident, which can be so, and all these extra tax rules apply to these people too, right?
Right. Excellent. Okay, we have about 15 minutes left, John. We have a couple questions, and then I'll let you give us some concluding remarks, which we'll know, which we pretty much all know where they're headed. Let's get done with these last two questions. Trump's new tax law states that foreign entities where a U.S. citizen is a majority shareholder will not be taxed similarly to domestic enterprises. Has this actually been implemented, and will it be enforceable in 2019? And then he adds a little bit of information, like some jurisdictions such as Dubai have a requirement of 51% domestic partnership of a company. Could one use this type of nominee structure to remove the tax obligation under Trump's new law? If not, are other options such as moving the company into a foundation be a viable alternative? What are your thoughts there, John?
Okay, yeah. So this is like 2-3 questions built into one.
Yeah, I know. Mm-hmm.
Let me deal with the first one, which I think. Okay. When we answer the first one, I think we probably can guess the answers to 2 and 3. I read that question when you sent it over this morning, and. Sorry, could you just read the first part of that again? Trump's new tax law. Read it to me again, please.
Yeah, Trump's new tax law states that foreign entities where a U.S. citizen is a majority shareholder will not be taxed similarly to domestic enterprises.
Okay, stop there. Thank you. All right. Now, you're talking entities, and I think what you mean are corporations here, right? Because under U.S. law, the partnership is a sort of a flow-through thing. So let's look at this from the perspective of corporations.
Sorry, John. There's a quick clarification here. The question is actually that if CFCs will be taxable.
Yeah, that's what I thought it was. Yeah, absolutely, positively, 100%. Yes, and the shareholders will be absolutely 100% destroyed. So let me explain why that is and how it works. So, basically, the U.S. In tax reform did one thing, and it reduced the U.S. corporate tax rate from 35% to 21%. Mm-hmm. And they claim to move towards a territorial tax system where the controlled foreign corporations owned by U.S. domestic corporations would not be subject to U.S. tax when they repatriated the dividend. To say that the U.S. moved to a territorial tax system is sort of like saying that in the old days, the Deutsche Demokratische Republic was truly a free democracy. In fact, what they did, although they called it territorial well, the way I put it is, when the U.S. moved to territorial taxation, what it actually did was vastly increase the territory over which it exercised U.S. tax jurisdiction. It's far worse than it ever was now. They've established something called the GILTI tax, and this applies to controlled foreign corporations. And we can get into, I mean, Karen and I will do this for you. I think we talked about this in early winter or something like that. But the bottom line is this, that all of the earnings of the corporation that are not paid out as salary or expenses to the shareholder will now be taxed to the individual shareholder, even though the shareholder never received money. So this is another fictitious tax event, you know, aimed really at the tax base of other countries. Now, I do appreciate that there are people who would find what I just said completely offensive. I do agree that it was somewhat of a generalization, but I don't have time to get into the very, very, very small amounts that are deducted from the whole amount that's income inclusion here. That's the governing principle. It is now, are there workarounds to that? Yeah, possibly. It's called a Section 962 election. But to answer your question, it is now a completely new and vastly more punitive, penalty-laden, and expensive world for U.S. citizens or domestic corporations that have the temerity to incorporate a business outside the United States where it is majority owned by U.S. persons. And I think that probably answered, I think you can guess the answers, you know, extrapolate the rest of that.
Excellent. Thank you, John, for that.
Section 951A, incidentally, of the Internal Revenue Code. You want to look at Section 951A.
Mm-hmm. Okay, and we'll get into GILTI, the GILTI provisions. Hopefully in February or March, we'll run a webinar on that with you and Karen.
Everybody who's listening to this should come back to that one in February or March. You will love
it. We'll get everyone riled up, right, John? Let me see. I think there's a follow-up question here. Yes, there is a follow-up question in terms of what we just discussed. So if the shareholding of the U.S. citizen is less than 51%, does that make it no longer a CFC?
No, absolutely not. Okay, it all depends on the totality of the ownership. Let me try this. I think I've got this right. Okay, basically, here's what a CFC is. A CFC, first of all, it has to be a foreign corporation. Now, I probably should begin by saying the fact that it's called a corporation under foreign law doesn't make it a corporation under U.S. law. So they're very elaborate, what are called entity classification rules to determine what kind of foreign entities are or are not presumptively U.S. corporations. But so let's imagine we're dealing with a foreign corporation. A CFC is where more than 50% of the ownership or the voting control, the voting power, is owned or exercised by United States shareholders. Okay, right. So it's not one person; it's the cumulative ownership. The next question becomes, what's a United States shareholder? Well, it's not just somebody who buys a share of, you know, Heineken beer or something like that, right? A United States shareholder is a United States person that owns 10% or more of the shares of that foreign corporation. Okay, so one, total ownership by United States shareholders by ownership or voting control more than 50%. Two, that total ownership must be made up of United States shareholders. To be a United States shareholder, you have to have 10% or more. Is that clear?
I think so. It's clear to me. We'll see. We'll see if we have more follow-up questions.
All right.
But then he follow up then with another question which says, let me actually read the question in all its totality so that you can get a better sense. So if the shareholding of the U.S. citizen is less than 50%, does that make it no longer a CFC and then makes the shareholder not liable to pay taxes on the retained earnings?
Okay, now this question has moved into the transition tax, I think. Is that correct? Can you confirm if the person is there? Are we talking about the transition tax issue?
He's happy with your first answer. And then he says, so if there's only one shareholder who is a U.S. citizen who owns less than 51%.
Golden.
Let me see.
Golden. You're golden. One shareholder, only less than 50%, you're golden. Or at least you're not covered by the CFC rules. But I mean, there are other problems of being a U.S. citizen. There are endless. Look, everywhere you look, there's problems with being a U.S. citizen. Okay? You know, so you escape one, you got another one.
Let me see.
If I could add to this, please, for whoever's asking these questions.
He just dropped an LOL, so he's having fun.
Okay. Well, let me just add something here for that that individual. You know, these are the most complicated provisions of the Internal Revenue Code and outside treaties of I think international tax generally. I would encourage you to go to the Internal Revenue Code and read the Subpart F provisions every night for, say, the next 5 or 10 years. Then I think you'll understand them. Okay, but it's incredibly convoluted stuff.
Okay, that's all you'll need, 5 to 10 years.
Well, and that may not be enough. I don't really know, but you know, I think that if you haven't got it by year 5, I think you need to move on to another hobby.
You said it's Subpart F, right? The Subpart F provisions.
They're called the Subpart F provisions. They're sections 951 to I think 965 of the Internal Revenue Code, the Bible of the United States. You'll find it there.
I think he's downloading them already, and he's gonna start reading them.
Awesome! I've changed a life today. Look at this. After December 6, 2018, my bedtime reading was the Subpart F rules.
There you go. Yeah, he got them. Perfect. One final question, just I guess for comparison purposes. Are there any other countries in the world that impose a similarly onerous exit tax on its citizens when they decide to give up their citizenship? Do you know of other cases, other jurisdictions?
Yeah, okay. So the United States is the only country that imposes taxation based on citizenship. Well, I know people talk about Eritrea, but absolutely not. Eritrea is benign. Compare Eritrea to the United States is a gross insult to Eritrea. There's nothing, okay, like the United States citizenship-based taxation system. However, the exit taxes have been a growing phenomenon for a number of years. And by exit tax, what I mean is a tax imposed on somebody when they sever tax residency with the country. It's just that in the United States, tax residency is based on citizenship. In other countries, it's based on residence, but that doesn't necessarily make it easy. So Canada and Australia are examples of countries that have I would call them exit taxes, but they would call them departure taxes because they are imposed when you break tax residency, and you break tax residency when you physically, well, in a general sense, when you physically move from the country. If we compare the Canadian one and the U.S. one, if anybody's interested, email me. I wrote a post on this one. It's a comparison. All exit taxes are really bad and dangerous. There's no question about it. But the Canadian one doesn't impose on retirement pensions and things that are equivalent to specified tax deferred accounts. It does impose it on foreign assets. In other words, what Canada and Australia, what they do is they do not impose exit taxes on things that Canada or Australia would retain tax jurisdiction over. Okay, meaning the only way to get your money, you can't get the money out without the Canada Revenue Agency knowing about it anyway.
Right.
So in that sense, there's no question they're far more benign in terms of what they tax. Mm-hmm. There's a second way they're far more benign, and this really is related to the whole citizenship taxation thing, is that I'm not aware of any other departure tax that would impose departure taxes based on the increase in value at a time when the person did not even live in the country, right? The problem with the U.S. exit tax is that it disproportionately affects Americans abroad because, you're not renouncing U.S. or any citizenship unless you have another citizen. And for many of these people, they have been tax compliant for 40 years or for 50 years in another country, and literally all of their assets are non-U.S. assets, right?
Right.
So, I mean, it's bad enough confiscating non-U.S. assets. But imagine confiscating the assets when they were earned or accrued when the person didn't even live in the United States. I mean, this is just absolutely over the top.
Right.
And it's also, by the way, a direct attack against the tax and capital base of other countries.
Mm-hmm.
Now, some of this stuff can be mitigated by treaties. There's for fictitious tax events, you get an artificial bump up of value in one country. But make no mistake, this is a really bad problem. Okay.
Okay. We have an interesting question here. I know this goes back to what you're saying about, make sure like you don't recommend renouncing your citizenship when you don't have another citizenship. And the question is, what actually happens when someone relinquishes their citizenship if they're not a citizen of another country? I mean, what are the... Sorry?
I'm sorry, finish, yeah.
Yeah, what actually happens when someone relinquishes their citizenship if they are not a citizen of another country? If they're out in the limbo, I guess.
Well, so they become stateless. So what does that mean? They're not a citizen of any country. I'm fairly active writing on this stuff on Quora, and there's a guy on Quora who, I may interview him for one of my own video series who renounced U.S. citizenship and is stateless and sometimes chimes in on this stuff. I personally don't think it's a great situation to be in. I mean, at a minimum, you are very, very significally restricting your ability to, your mobility to other places, right, that require passports and that. But I mean, for a certain type of person, it's obviously possible. I mean, the United States, you want to renounce, at least as it stands today, you have a right to renounce. They are a lot of the consulates are very, very, very careful to aggressively make sure that people are a citizen of another country, which I think is a good thing. But yeah, you can do it. You can renounce. I don't think it's a good idea, but there are people who do.
Okay. Some concluding remarks, John. Anything that you want to add that you have not said already? I was going to wrap up with your last kind of your last words there. With all you said with a lot of passion. I was going to wrap up there, but then we got this extra question, so I'm going to give you another chance to kind of get into it again.
You know what? I'm gonna just cut the rhetoric here a little bit. I mean, what my views are of this, and I by the way, sometimes you can say, well, these are my views, and they may be wrong. These are my views, and they are not wrong. Okay, for anybody who's actually been affected by this. But let me just say this: that there are advantages to U.S. citizenship, and I do think the United States is a great country with a great history. I mean, if you watch, for example, the funeral of President Bush yesterday, and all countries go through ups and downs and sideways, and I do think that U.S. citizenship does have value. Problem with it is that because of FATCA and an internal revenue code that is so hostile to anything that's foreign, it's made it practically impossible for U.S. citizens to both be tax compliant, as U.S. tax compliant, and live outside the United States in any kind of a normal life. So, in my view, people are being forced to renounce citizenship. I don't think they have any options anymore if they want any chance of being able to provide for themselves in retirement. In 1967, the United States Supreme Court issued a decision in a case called Aforium, which really opened the door on these problems, which essentially gave Americans a constitutional right to dual citizenship, which has led to these problems. But at the end of his decision, Justice Black summarizes the holding by saying that basically the reason why there's a 14th Amendment right to U.S. citizenship is so that one group of citizens, that is Congress, cannot make laws that deprive another group of their citizenship. And this is actually what's going on right now. I mean, the exit tax is a manifestation of what I've begun to see. Really is a forced citizenship thing, and I expect that before the final chapter on this is written, that this may be relitigated in terms of whether the U.S. can impose these rules on people that on the one hand are forcing them to renounce U.S. citizenship, but on the other hand are taking their assets when they do renounce. Mm-hmm. So there you have it. There's a few thoughts on it. It's ungodly. It's it is indescribably horrible for the people who are caught in this.
Right. We have one final question, and we'll wrap up with this one, John. And
Sure.
This will be the last one, and then I'll jump into some, just to conclude the webinar. The final question: at what level of net worth does it make sense to you for a U.S. citizen to relinquish citizenship from a tax perspective? I guess this is an opinion, really.
Well, I think that obviously, I mean, the easy answer is before they hit the 2 million. The question is, if you're over the 2 million and you're paying an exit tax, when is it worth paying an exit tax or not?
Right.
And, I don't think there's a universal answer to that. I think it depends on people's ages, their ability to recoup things. But the way I generally, I was once sitting in the office with somebody and, we figured out she'd have to pay $300,000 exit tax, if she wanted to renounce U.S. and she was horrified. It is horrifying. But, I asked her the following question. I mean, let's say you had $300,000 and you were looking for an investment return on that money. Okay. What could you get in return for that $300,000? So we began analyzing, what could she get in return for the $300,000 that would be a benefit, by no longer having U.S. citizenship. And we got, it didn't take too long before, she concluded that, maybe paying that $300,000 was a good investment. Now, I've helped people renounce for reasons that include they're offered part ownership in companies, and if they're a U.S. citizen, they won't allow them to be owners of the companies. I think in a case like that, obviously, you just compare the exit tax with the benefits of owning the company.
Right.
I think the answer to the question is it's not some numerical level.
Right.
It's what is the cost, and if you have that money, what kind of a return can you get by putting yourself in that position? I think that U.S. citizenship for people who are entrepreneurs or who want to be mobile, I think it's a very, very dangerous thing to have in a global world.
Excellent. Thank you very much, John, for being with us. We actually look forward to having you again in February or March with the guild provisions and Karen too. So let me get some admin issues out of the way. We have recorded this webinar. We will have an audio recording available for all of you probably early next week. We will have a full transcript that we'll share with all of you. If you have been paying attention and you want your CPD credits, get in touch and we will issue those for you. If you have any follow-up questions, just post them on the forum, the relevant forum discussion, and we'll make sure that John gets to those and provides you with some additional details. So without that's all I have from my end. Thank you, John, on behalf of TaxLinked, and we look forward to our next one. It's always a pleasure having you here with us.
Hi, Matteo. I want you to call the series of seminars the Confiscation Series. Okay, the Confiscation Series.
Confiscation series. That works. We can make a nice little package.
That's exactly what it should be. Yes.
Excellent. Thank you very much, and have a good day. Thanks, John.
Right. Yeah. See ya.
See you. Bye.